Time now to spotlight Tesla. Shares gaining more ground today, up a little more than 2%, extending their advance this month. Joining us now for insight, we've got Seth Goldstein, equity strategist and resources chair, EV committee, Morningstar. Seth, thank you so much for joining us today. We've got a few things to dig in today when it comes to Tesla. We're seeing a Reuters report that they're restarting some component shipments from China. Obviously, that was a headwind. I'm sure you remember Elon Musk called out, even though they have less exposure to tariff risks, such as like a Rivian or Ford. There's still some exposure, but it looks like obviously with this 90-day truce that limits the challenges there. What's your view on how much the shares have advanced this month and the catalyst around that?
Well, we think as we've seen good news that's led to a broader market rally, including a tariff temporary reduction between the US and China. And it seems like the first US trade deal was signed and more will be maybe coming in the near future. The market's getting more optimistic that the tariff situation and the economic uncertainty may not be as big of an impact for automakers in general, and especially Tesla, where Tesla is a luxury automaker today. All of its vehicles sell well above the average price point for autos. And so oftentimes when there's economic uncertainty, consumers could hold off on a bigger ticket item, which makes the 2025 deliveries forecast more uncertain for Tesla, following an already down first quarter. So Tesla needs to make up ground if it even wants to break even as far as number of deliveries in 2025. So with those more economic uncertainties, more optimistic news coming for Tesla, now I think shares are rallying and the market's focusing more on the autonomous vehicle robotaxi testing that's coming up next month in Austin as a catalyst for shares as Tesla aims to launch its robotaxi service as early as next year.
Okay, so let's talk about, you see fair value for Tesla at $250 a share. It's nearly $100 beyond that right now. You had that view before this news about tariffs. You still have that view. Why do you still have that view?
Well, our view is that Tesla will see deliveries slow down this year, especially as we saw a down first quarter. And we think that the general current product lineup is about at market saturation. However, we're very bullish on the robotaxi long-term outlook. While we don't think the robotaxis will start in service next year, which is what Musk wants to do, we do think they'll start by 2028. And over time, that will be a more important value driver and faster growing value driver for Tesla. So we thought Tesla was well positioned versus other automakers to see less of an impact from tariffs. We think some of the company's ongoing cost reductions would result in either Tesla not having to raise prices as much or being able to, eat more of the cost of tariffs and not raise prices at all if it wanted to gain market share. So while we thought there would be near-term uncertainty for Tesla before tariffs, we still see a bright long-term future, and that's the bulk of our 250 valuation driver.
Do you think that there is a potential catalyst with this cheaper Model Y, or do you think it's too cheap in terms of the impact that it could have to margins?
Well, I think Tesla will not launch the vehicle until they're ready to make it profitable. And Tesla aims for about a 20% gross profit margin on all of its autos. So I think when Tesla launches this and ramps up production, it will be in line with at least the automotive segment average. So I think the vehicle will be a driver, but at a lower price point, you're talking about a lower dollars impact on a profitability. But I do think it will be the key driver for Tesla's deliveries in 2026, returning to growth, because this new, more affordable SUV, while we don't have all the specs yet, I'm expecting it will come out at a mid $30,000 price point. That puts it comparable to Toyota RAV4s, Honda CR-Vs, which for the affordable midsize SUV market, those are the two largest selling vehicles. So I think it will do very well with consumers.
Let me ask you this, Seth. So there was a Financial Times report today about this special committee that the board has formed to, deal with this issue around Elon Musk's pay package. Kind of felt like that was on the back burner, but there is, it's still going through court. They've formed this special committee that they're weighing this new stock-based pay deal or alternative compensation. What's your view on that and what it signals with regard to confidence for Elon Musk as just retaining his role?
Well, it's been my view that Elon Musk will be able to retain his CEO role as long as he wants to for the foreseeable future. When we saw a report in the media in early May that the board was considering a replacement, we saw Tesla shares down. We see Tesla shares up today, and I think the Financial Times report is a key driver of the shares being up today. And so that really highlights the key person risk for Tesla, where the market feels that if Elon Musk is going to leave, we'll see market confidence in Tesla decline, but any news that would lead to Elon Musk staying longer would lead to the market being more optimistic about Tesla's growth prospect, because Tesla's ultimately trying to transition itself from an automaker into an autonomous vehicle provider and a humanoid robot provider, which is a pretty big business transformation. So if the Tesla is going to be successful in this transformation, Elon Musk is the person to lead, and I think the market will move shares based on the likelihood that he stays longer.
Okay, the likelihood that he stays longer. And he has obviously made the point that he continues to reiterate the point that Tesla is not a car company, it's an AI company. But I would gather that your approach is you are valuing it as a car company right now. Is that how you are valuing this? And is there the potential for a shift given what his vision is?
So when we're valuing Tesla, we value all of Tesla's businesses, including a new venture into robotaxis, a new venture into the Optimus humanoid robots, the energy generation and storage business, and other ancillary businesses such as insurance in the U.S. and charging. So we value all of Tesla. But the reason why we're a little more bearish on the stock versus the current market valuation is just we have a lower valuation for Tesla's robotaxi service. First, we think the robotaxi service won't officially be launched until 2028, 2 years after Elon Musk's goal of 2026. Also, we think it will see a lower addressable market because it's going to see competitors already from Waymo is already in 5 U.S. cities, growing to 7 next year. And so we don't necessarily think Tesla will benefit from the first mover advantage. Also, we see a far slower growth rate for deliveries in the coming years. While we're optimistic the new Model Y will grow deliveries as a whole, we don't think Tesla will get anywhere near bullish forecasts of Tesla being the world's leading automaker, even a top 2 or top 3 automaker. We think Tesla will grow, but generally the difference between our valuation and the bull case or the current market price is just we assign a little bit lower valuation to a lot of these businesses.
Okay, and then Seth, I just want to get a final thought with you. Since you see the timeline as being more of a 2028 story, is that because of how ambitious Elon Musk has been with timelines in the past and then having to push those out?
I think so. I think Elon Musk aims for the quickest possible timeline, especially for new ventures. And the move from just product concept to testing this year is a big first step in the right direction. But I just don't think the software is going to be quite ready for a complete driverless robotaxi anytime soon. I think it's still going to need more iteration, longer testing periods. And we've seen this with other autonomous vehicle providers. Waymo famously tested for years in its market before it was ready to launch a service. And I think Tesla will likely have to do the same, which puts the timeline out. But over the long term, over the next 5 or 10 years, I think Tesla will get there, and that will become a larger part of the valuation.
All right, well, shares of Tesla right now gaining more ground against some softening in the broader market today. Seth, thank you so much for your time. That's Seth Goldstein, equity strategist, Morningstar. Thanks, Seth.